Hello, welcome to this podcast on corporate governance. Guide SMEs with confidence and clarity. I'm Peter Towers, founder and managing director of ESS BIZTOOLS. And this presentation is by ESS BIZTOOLS, Accountant's Minute, edition 409, Corporate Governance. Guide SMEs with confidence and clarity. I hope you're having a wonderful day. Let's look at what's involved in corporate governance, because this is a very important issue for accountants and bookkeepers to be familiar with, to make sure you have having communication with your clients about what this subject, which is a bit of a mystery for a lot of people, really means. It includes some legal obligations, but it also includes generally accepted best practice for people performing duties to which they have been appointed or elected, that they are acting on behalf of a wider group of people, whether they are the shareholders in a company, the members of an organisation, the members of a sporting group, who are relying on their committee or their directors to ensure that sound business practices are followed by the organisation, to protect the assets of the organisation. So corporate governance isn't just for big business. It's essential for every organisation, whether it's a company, private company, unlisted public company, but even a partnership or a trust, or a sporting organisation, a charity, a not-for-profit, or a church. There's legal obligations that are informed for everyone in the Corporations Act, and that's primarily applicable to company directors and company secretaries. And then within the incorporated association legislation that each state has, there is legislation covering charities and other organisations that wish to trade in a business-like manner. And these organisations all have rules and regulations. And then within individual sporting organisations, charities, not-for-profits and churches, there are normally processes, rules that have been imposed by the governing organisation for those activities. And what the whole idea is trying to convey a set of processes, a set of rules to guide the people who are given the authority to administer these organisations, the directors or the committee members. I've been very aware of corporate governance issues for a long time because I've been involved in private companies and a major public company as the company secretary and as directors of private companies and as director of the public company that I was involved in's major business operation. So you learn to understand the rules and regulations. Within a public company, I was very much aware of the stock exchange rules, as well as the Corporations Act. But in private companies and other organisations, we don't have to worry about the stock exchange rules. Directors, committee members and leaders must understand their legal obligations to properly perform your role. At ESS BIZTOOLS, we have developed a corporate governance package, which is within our client mentoring and coaching segment, where we have 13 different types of services that are required to be delivered that SMEs are involved in. And obviously, we're looking today at corporate governance as it applies to that range of organisations that I've already referred to. So the first package that we have in that system is directors' duties under the Corporations Act. They're there, they're stated, and they also apply to company secretaries. There's a range of service requirements for company secretaries. Directors should be aware of what the company secretary's requirements are so that they're familiar with what that person's duties and responsibilities are. But individual directors should also have an understanding of what the legislation says about their role and responsibilities, because that's very important in that they should understand the duties that they have under the legislation. And directors can make mistakes, not just in private companies, but also in very large public companies. And some of these directors that have a problem with public companies are very experienced and have been involved in a number of other public company boards, yet they can make what the law has decided were mistakes by not properly following through with decisions, by not carefully checking the minutes of board of directors meetings, by not bringing to the chair's attention that the minutes did not record that they voted against a particular resolution, which is important, by bringing to the chair's attention that they were against a particular discussion, yet it's not recorded in the minutes. The minutes are very important for all organisations, but particularly for private companies, unlisted public companies and public companies, that the minutes do record what occurred at the meeting. And if a director left the meeting for a period of time, it should be noted that the director left the meeting at 10:42 a.m. and returned at 11:06 a.m. because in that intervening period, there could have been a major decision made. And the problem is, if there is litigation over decisions of directors, the courts look at the board of directors' minutes. And if the absent director had not ensured that that person had left the meeting for a period of time, they could find themselves caught up in major problems, as has happened in some cases. Responsibilities of committee members under the various state governments' incorporated association legislation is also important. And whilst it hasn't got quite the legal significance as the Corporations Act has, it's still important. And it can also affect a person's reputation and their confidence in undertaking these types of activities. So people need to understand what these regulations are. As accountants and bookkeepers, we have to appreciate that various people get appointed as board members and members of associations, and they have no knowledge of corporate governance type matters, how the processes operate within directors' board meetings or committee meetings. And they might have very little knowledge of financial matters, but they may be an expert in another area, or they're a good committee person, they support the organisation. But they need to be mentored and coached on these other areas that can cause them significant problems. if they are unaware of them, because the law looks at a director as being a person that's accepted that responsibility and understands the duties and responsibilities that comes with it. And that's why we have produced this material. So let's look at some of this knowledge that directors need. Obviously, they need to understand the duties and responsibilities and the processes. And if they disagree with the recording and the minutes, they should be making an appointment to talk to the chair of the company and say, I disagree with the way the company secretary has worded these minutes. I voted against that, or I spoke against it. And there's no mention that I spoke against it, because it could be 4, 5, 7 or 8 years' time that there's a court case involving decisions that were made by that board of directors, and those minutes are being produced. And if they don't indicate that a particular director spoke against a particular subject matter or voted against it, it's very difficult for that director to argue that they should be treated differently from their colleagues on the board. And directors need to understand this. They just don't have to sit back and accept things, but they need to raise it within a period of time, preferably before the next meeting, so that the chair is aware, and at the next meeting they raise it and have the minutes amended. Some directors habitually record their own notes on meetings and keep those files. And that's not a bad idea if you're in a contentious situation. So you need to be able to talk to your clients about this, to get this message across to them. Let's look at financial literacy. Directors and committee members are reviewing financial data very regularly. Or they should be at their board meetings or committee meetings. But what's it all mean? Directors need to understand what this terminology talks about. What is the gross profit? How's it calculated? What is the debtors' days outstanding figure? How's that calculated? What's it mean? What's it conveying to the director? What's the projected shortfall of money mean? Are they being told that financial projections have been done 12 months in advance? Or if they haven't, are they requesting that the CEO arranges for financial forecasts 12 months in advance to be available, so that they can really look at what the future cash positions are going to be? Directors are not expected under the legislation, and the courts definitely do not expect them, to just be sitting there as muppets accepting what's fed to them. They are an individual group of people assessing how the leadership team are operating the business. And they are empowered to ask questions. And in fact, they should be asking questions and demanding answers. And if they don't understand the terminology or the technology, they should be going to the chair and saying, I don't understand this, or perhaps if there's a few of them, we don't understand this. We want to receive special sessions with the experts so that we understand what these discussions are all about, because we are empowered to vote for or against them, and we need to have some knowledge if we're going to properly perform our duties. This is very important. And this should happen in public companies. The interpretation, therefore, of the key financial data is important. Not just sitting back and accepting it. That means looking at the profit and loss accounts, the balance sheets, looking at the key figures in the balance sheets, the debtors. Is there major problems? Let's look at the debtors' days outstanding analysis. If the terms of trade are 30 days for the business and there's significant numbers of transactions listed in the over 50-day list, what's causing that problem? Or is the organisation facing the prospect of substantial bad debt write-offs? And what will this do to the financial position of the business? Because unless that analysis is undertaken, as you know, that debtors figure is included as an asset of the business. But what's going to be the effect if it's not? I've already mentioned cash flow. Cash flow projections are very important. The board should be demanding that they're being told at each meeting, which in most boards would be a monthly meeting, what's the forward estimates of the cash position within the business. Now, there can be reasons why the cash figures are varying and perhaps decreasing and maybe going into the red. It could be because there's had to be inventory build-ups because of uncertainty of receiving supplies from overseas relating to the wars that we unfortunately are being fought in various parts of the world at present. And that's meant that the shipping companies are taking longer, and therefore businesses are saying it would be prudent for us to build up our inventory. But that can have an effect on cash flow. It might be because of a capital expenditure project. But as the capital expenditure project got out of hand, if it was estimated to cost $600,000, why is it now over $1 million? And why are we now being told it might cost $1.3 million in total? Who made these estimates? Who made the mistake? Directors need to know this information because it will help them assess future application. Or is there a research and development project that's looking good, but it's costing a lot of money, and there will be no government tax rebate benefit until next financial year because you got your information and you get the benefit in the following year. So does the cash flow deficiency start highlighting that the entity may need to raise some additional money? Where's the money going to come from? Directors should be asking. Has the organisation got the ability to offer assets as security? Or should there be an analysis of capital raising opportunities, utilising crowdsourced funding equity raising? Or Section 708 of the Corporations Act? Or if the company is a young company and with a fairly low income and a low expenditure, could they utilise the early stage innovation company? So these questions need to be getting raised at directors' meetings and recorded in the minutes. Internal control systems, vital. And that's one of the key roles of a director, to be saying, well, where could problems occur? Internal control means that there's authority given to people to perform various roles, but there's a cross-check on what they're all doing. And if there's a breakdown in internal control, it can lead to major problems in an organisation. And this is all part of corporate governance, making sure these protections have been implemented for the benefit of the shareholders. And directors monitoring these activities need to be doing it in a very conscientious manner and making sure updates on comments on the internal control system are recorded in the minutes. Because unfortunately, it may be a major issue in a subsequent court case. And risk management is another area of great concern that directors should be making sure that the leadership team has followed through and implemented strategies for risk management. The first thing is to acknowledge what risks this particular business is facing. Now, some will be commercial risks that a new competitor might be going to open, but it would be prudent if the leadership team had already prepared strategies to combat a new competitor. And maybe the competitors are giving grades. One might be an SME sort of business. The other could be a major multinational type business coming into your sphere of operations. How will your business compete against them. But what about other areas? What about risk from COVID and other diseases, from natural disasters? And we're having a lot of those in Australia of late, aren't we? What's the directors and leadership team and the board of advice members looking at when considering these sorts of items? Board meetings are very important. They're crucial in the whole concept of corporate governance. Board of directors meetings should receive reports for each individual director in writing or sent to their own computers so that they can attend the meetings. And in my opinion, the practice that many public companies now have is that the board papers are distributed 3 to 5 days prior to the meeting. Why? Because we want the directors to have read the material, to have thought about it, to have made some research if they need to understand what those figures are, to look back and what was said at previous meetings on that same issue. Is there contradictions? Is there new information being disclosed? Do the figures make sense, or do they appear not to be right? So that when the director attends the meeting, he or she's not walking in undoing the envelope that the information was sent to them in, or going onto their computer for the first time looking at it. They've already read it and their brain's in gear. They've got questions ready. They are prepared to participate in the debate. This is corporate governance in operation. And this is the message I think you have to get across to your clients. The directors need to be serviced in this way. And this will mean in many cases in private companies that there's an opportunity for you to say to the chair of the company, we are quite happy to present a training program to assist directors, in particular new directors, whereby they are giving a briefing as this is how this company operates. These are the resources. This is the team. These are the duties and responsibilities of these people, so that there's proper disclosure to them as to how the business operates. So this is covering the reporting expectations. How often are reports expected? I think it should be on a monthly cycle. Monthly cycles are great for directors, but they need to ask questions and get answers and make sure all this information is documented in the minutes. Leadership team development is important. Directors should be very conscious of succession within the organisation. The key position is normally the CEO, managing director, whatever you want to call him. But directors are also very concerned about the other key positions in an organisation. If your client has an employed accountant or a chief financial officer, succession of that position is very important. Sales manager, production manager, directors should be aware that the leadership team is strong and that there's been consideration given to succession. Now, that could be internal training and mentoring. That there's been identification undertaken of up-and-coming younger people in the organisation and that they are being appropriately trained. They've been encouraged to undertake additional courses so they understand financial literacy, they understand processes. They participate in the Australian Institute of Company Directors Diploma course or in the SME training for directorship that we have presented within ESS BIZTOOLS. All this is corporate governance. And there's insurance and contingency plans and strategic budgeting that's also very important to understand what's happening. So directors' meetings are not a cup of tea or a glass of wine and a bit of a discussion and some of the meeting discussion, the football team's results. They're far more serious than that. Directors and committee members should be reading their reports before the meeting, should be turning up at meetings in gear, ready to ask questions and move on to in-depth discussions. The leadership team need to be aware that the board of directors are looking to pose questions and raise issues so that they're kept on their toes, because this is part of keeping a company lively and keeping to the strategy of what the directors have set as the policy. The directors set the policy, or the committee in a not-for-profit or a charity set the policy. The leadership team or the management team are then empowered with implementing that policy. But the directors should be getting reports monthly or bi-monthly as to how those strategies are being implemented. So by offering these insights to your client, you're offering services that will mitigate risk and will help the directors of that organisation avoid embarrassment and financial cost through misadventures in performing their role as directors, in being a lazy director, not asking questions, not following through, not reading the briefing material. That person is not playing their part in the board, and the chair should be aware of that and having a one-on-one discussion and saying, look, there's 5 people on this board of directors, you're not participating, you're not asking any questions. It doesn't appear as if you're doing your research before a meeting. It's important that you do your research. It's important that you do ask questions, because that's all of us performing our role as directors. By utilising this package, you will assist your clients to improve leadership accountability back within the leadership team, because they will know that this board of directors that they're reporting to is on the ball. They're aware of what's going on. They're looking at things in a different angle, but they need information and they'll be asking questions. A strong board of directors or committee undertaking these sort of processes will build confidence with the other stakeholders, so the shareholders, the members of an organisation. But the backers of it, the banks, the partners in other activities, whether it's the media or sporting organisations, dealing with major companies for sponsorship, all require those other organisations to have confidence in their ability to properly deal with money, to make sure there is no money being siphoned off in illegal or unauthorised manner. And all of this will help the company or the organisation plan better its future operations. We've all read stories of companies that appeared to be going all right that suddenly fail, of organisations, whether it's sporting or not-for-profits, that appeared to be going okay, and suddenly there's problems. And what happens then is their ability to raise money as donations from the public dwindles, because the public's lost confidence in them. The public's seen reports which say there's been fraud in those organisations. Fraud comes back to a problem at the directors or committee members level, because the allegation can be they never insisted on proper internal control systems being implemented. So this is my overview of what corporate governance means. It means setting up a series of systems and processes that ensures that information is being conveyed to the members of the board of directors or those committees, and that there is a direct understanding going to the leadership team that the board of directors is not just a cup of tea or a glass of wine type function. It's serious business that requires reports being submitted on an ongoing basis back to that board or committee so they can assess how the organisation is performing. ESS BIZTOOLS has the corporate governance package, which you can subscribe to. But I think you'd find far more benefit in subscribing to our complete packages. We've got 3 major overall packages which will assist you to deliver your services to your clients. We have the starter package, which is ideal for bookkeepers and accountants who have not previously been involved in advisory services to get started on this journey. Then we've got the advanced package, which is for accounting firms and bookkeeping firms that may have been generating around 10% of fee income from advisory services to start getting more involved. And then we've got the financial forecasting package, which is the full virtual Chief Financial Officer service to enable you to deliver that virtual Chief Financial Officer service to a number of clients. And perhaps if you wish to aim towards ultimately having a 50-50 split between revenue from income tax advice and taxation return preparation and advisory work, that could be the package for you. If you've got any questions, please send me an email, peter@essbiztools.com.au. But what I'd really like you to do is to visit our website, www.essbiztools.com.au. If you visited us some time ago, we have revamped our presentation in our website. It's a process that's nearly finished, and I think you'll find that there's a whole range of interesting information that you can use in your professional service firm to supply an outstanding range of services to assist your clients, whether they're companies, not-for-profit charities, sporting organisations or churches, to achieve their aims in a legitimate business-like manner. Thanks for listening. Have a great day. Goodbye.